Yes. Right. So let's see feedback. Let's make the word bigger. Okay. I'll make this like 40. Okay. So hopefully you guys, because this is like the biggest font, so hope you guys can also see this. Oh, I'm good. Right, perfect. Now we're talking about institutional manipulations and stock run. This is where we're going to talk about equal lows, equalize. Now, I think Bailey might have mentioned it in one of the sessions about equal lows, equalize, but you know me, in my own session, you're going to get everything deep. I'm the kind of person who likes to understand the reason why things happen. Why do equal lows get smashed? And equalize, in what scenarios you want to see equal lows get smashed for equalize, all this kind of stuff, okay? And I'm going to show you lots of examples on how you can use all this to your advantage, okay? It's a very vital tool to get in your arsenal of trading. Learning how to understand institutional manipulations and stop runs. Now, in this segment, I'm going to talk about this liquidity run. So we're doing liquidity run and power 3. We bracket week. Liquidity run power of 3 week off method. Okay. So this is going to be a very interesting session. Now, with 34 people on this call, we have 91 people in the group. That's sad. Anyways, so now you're going to see when the market creates highs and lows, it's always going to be just one last run for that level. Okay? The market is going to do something like this. Let's see. Brush tool. So the market would seem to go up, then it's going to look as if it's pulling away from a higher time frame level. So now let's call this a daily order block. Okay. So let's see. Someone just said gold came down. Oh, yeah, perfect. Look at gold. Massive. Long spike up. All right, so let's get back to what was that? I think it was TXY. TXY? Let's see. Nothing. Okay, cool. So make this small. Oh. Okay, so now let me try to get this off. This is crazy. Let's see. Let's do this. Oh, Dylan, says it's sorry for missing everything. You're okay, bro. You're okay. Oh, finally back. Yeah, gold got to about 300 pips. Crazy. Unfortunately for me, I still held gold. So, it's crazy. That's about 1,200 pips. Wow. Wow. Let's see, gold gapped up. So gold, I can just come back down. All right, so let's get back to our lesson. We're talking about institutional manipulation and stock runs. Okay, so how can we use this to our advantage? How can this be of help to us as traders? Now, Everyone is all talking about the gold stop run. Gold just came out and there was a 300 pip gap. Okay, I saw you guys mentioning that in the comments and even on the Telegram group. Okay, everyone's talking about gold. Now, this is a very clear example of what I'm trying to teach you guys today. Okay, so remember I told you guys that before we want to look at gold dropping down, we want to see gold tap deep into this level. Okay, now why is that? The reason why is because there's gonna be lots of fund stops resting just above this level. So I want you guys to write all this down. Okay, get your notepads and write this down. Whenever you get an area of old highs and old lows, okay, areas of old highs, old lows is usually going to be a stop run just to that level. Okay, it's always going to be a stop run to that level. The reason why is because even though the institutions, look at US 30, okay, all right, gap. Yeah, it's gonna be like thousands. Just 30 is one crazy pair. It's gonna be like thousands of pairs. US 30. All right, so whenever you get levels of old highs, old lows, you're gonna get stop runs to that level. The reason for stop runs is for profit making. Okay, stop run is a cheap way for the institutions to make profit off the market. Okay, now when you hear stuff about stop runs, it means you're getting your stop losses. Now, let me make this very clear distinction. You as a retail trader, you're not being targeted by the central banks or the institutions. Okay, whenever you place your stop losses, there's a chance that there is a collective herd of people or retail traders who have stop losses around that region too. There's going to be a collective herd of retail traders having stops around that level. And then when you get to major highs and lows, there's going to be fund protective stop losses resting around those regions. Okay, this is why when I bought gold from this level, I was looking at gold getting all the way to this level, then this level. This is why I held gold all the way going into this level. The reason why is because I knew there's gonna be some fun, or lots of fun guys, okay, who will be bearish from this level and inside this field, thinking the market is gonna drop down, and then will protect their positions with buy stops around this level, old highs. Okay, I think Telegram is kind of, oh come on. All right, so stop run. A stop run is when you see quick price action to old highs and old lows. Okay. Now, by the way, don't get distracted with the 300 pip gap on this 30, whatever. Okay. Let's forget about all that. You're gonna have lots of trade this week. Okay. Now, notice that the guys who are focusing on just a 300 pip, blah 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 blah. At the end of the day, you're still not making sufficient withdrawals every week. So it's not about you getting the gap or being lucky and all that. Okay, we're trying to be intentional in the way we make money. Okay, so just be patient. Okay, calm your nerves down and then learn what we're teaching today. It's gonna help you going into this week and in the future. Okay, so now someone asks, what do I mean by a stop run? A stop run is when you see the market create an high, the market looks like it's dropping, then out of the blue, it spike up, the market goes down. Okay, or you might see equal lows, the market starts to go up, and suddenly the market smashes to that equal low, then reverses all the same. Okay, this is a stop run. Okay, whenever you get double tops, stop run. Equal highs, equal lows, old highs, old lows. Logical places where retail traders, where collective herd of retail traders, not just one retail trader. I'm talking about a collective herd of people, okay, where there's going to be enough liquidity for the market to, that it's going to be profitable for the market. So now, the reason why stop runs do occur is because it's profitable for the person moving the market. In this case, I'm talking about the market makers. It's going to be profitable for them to move the market to that level. Okay, so now let me give you an example. You see double bottom here, and then the market starts to go up. What does your traditional retail textbook teach you about double tops and double bottoms? When you say double bottom, what do you do? Do you buy or you sell? I want you guys to answer my question so you guys can see what I'm trying to get at. When you say double bottoms, do you buy or you sell? You buy, exactly. Yeah, so when you see double bottoms, you're gonna buy because this is what they teach you. Buy the W's, sell the M's. Okay, so now when you're buying the W's, the surpluses is gonna be where? Just below W's. Am I right? When you're buying your W's, the surpluses goes just below the W's. So you're having surpluses resting below double bottoms. There's a massive likelihood, okay, that not only you saw that double bottom, okay, not the only person going to see that double bottom. It's going to be you, Mark from Canada, Luke from England, from different countries around the world. There's going to be lots of them that see that same double bottom, and you're also taking orders and placing protective subs below that double bottom. There's going to be also people, okay, who trade for the hedge funds, because remember, people who trade for hedge funds were once retail traders who just add consistent profitability. Okay, so hedge fund traders are also the same as retail traders. They still have the same retail mindset, just that they have a system to the way they trade. Okay, but the same way they trade is the same way you trade. Okay, the only difference is you have your one standard lot sizes and your two standard lot sizes. They have 100, 1,000 contracts as they go when they're placing trades. So the only difference between you and the hedge fund traders is the amount of money you have as capital. Okay, but it's the same thing. If you're seeing this double bottom and you're buying it, you're gonna have surplus just below. Okay, and then the collective herd of retail traders, along with some of the hedge funds, are going to see this same pattern in the market. Okay, you're going to see this same thing, and then you're going to be buying the market with surpluses just below double bottom. Okay, so now what that happens is that forms a pool of orders below that double bottom. This is the way stop runs are engineered. Okay, so I'm giving you the breakdown. This is the breakdown of the market. So people see this kind of pattern and then think, okay, they're going to buy the market because they read in one PDF. You see double bottoms, buy double bottoms. Okay. If you see W's, you're buying W's. If you see inverted head and shoulders, you're buying them. Okay. All this retail bullshit, classical support, and blah, blah, blah. Okay. When people see this, this is their logical response to the market. People, humans, like to find patterns in things. This is why everyone wants to learn the head and shoulders, W's and the M's. No one wants to learn about the liquidity run, all those things, because it's not a set pattern to all those kind of market behaviors. Okay, this is why people often opt for the retail stuff, the double tops and double bottoms. So whenever a classical price pattern plays out in the market, okay, you're gonna see lots of reaction to that. This is why price is engineered. So this double bottom, okay, in some cases are being engineered for people to take action based off what you're seeing. Okay, so the market is going to engineer a double bottom or a W, and then it's going to start to fake like it's going to go up. Then lots of people start to buy. There's going to be collective pool of stop orders resting around this level. Okay, so now that collective pool from the retail herd and then the the hedge funds could be like around 20 M. Okay, so when let's use 20 million US dollars. Okay, that's M. Okay, so from you in the US, from the next guy in Canada, from the next guy in the UK, from me in Nigeria, from another person in Australia, wherever, all around the world, people learn the same shit, okay? And then you're taking action based on the stuff they learn, okay? They, along with the hedge fund retail traders, doing the same thing. So this is going to give a collective pool of massive liquidity resting just below this level. Now, as the market starts to go up, these guys who all bought the market are all in profit. So now you need to ask yourself a question. If the hedge funds are buying, if you are buying, if the collective herd of people are doing the same thing, who is taking on your orders? Okay? Who is selling to you? Let's use it that way. So if you're buying the market, someone has to sell to you. Who are you buying from? That's the first question you need to ask yourself. Am I doing the same thing every other person is thinking of doing? That's the first question you ask yourself, because most likely what the herd is doing, okay, selling double tops, buying double bottoms, this is the easiest way institutions use to get money via stop runs, okay? Stop runs. Now I'm going to show you guys an example. Old highs, old lows. Very logical places where retail or the hedge funds are most likely to place protective stop orders around. Okay, sell double bottom. Big sell double. True though. So let's see. Move all drawing tools. Let's look at gold. Okay, gold. I showed you guys an example. If people are buying inside this range, they are gonna have protective sub around this level, old highs, okay? Old highs, stop runs, okay? So now, let's see. I actually wouldn't really call this a stop run this year. It's kind of like this is another topic on its own. So I think I will handle this another day. But look at the market before any major. So now let's just mark out all the swing points. And you're going to see around that swing point before the market turned, there was a stop run back to those levels. Okay, stop run back to those levels. So let's go to the 1 hour time frame. So take to the left. All right. Okay, so if you look at this level, the market went up. Okay, before the market turned, there was one more attack back to these lows. Okay, now look at these lows. That was where the market valued from. Before the market went up, came back. Okay, came back to that level. So if you pull out a line there, okay, line from this level, you're gonna see the market fake like it wanted to go up. Then out of the blue, just one quick spike. Very quick spike that the market quickly pulled away. Now, if you were buying from this level or from this level or around this level, you're gonna have your stop loss just above this level because you're not expecting the market to come down to that level. So everyone buying around this level had protected stop losses just below this level. This is why when you see the market get down to this level, you're gonna see one very quick spike. Okay, the same thing to old highs wherever the market is turning from wherever you see there's a major reversal from, there's always going to be stop runs from those levels. Okay, so you have one level here where the market went to, and it came, the market went to, pulled away, and went back to that level. Now, it seemed as if the market wanted to drop from this level. The market went down, then all of a sudden, there's one quick spike back to this level. This is your stop run, okay? This long spiky candle is your stop run. Long spiky candle is your stop run. Boom. Okay? Long spiky candles, stop runs, stop runs. Stop run here. Okay? Stop run there. Then before the market went up, stop run here. If anyone was buying, stop run. And obviously if we're selling, the market eventually stopped you out and went up. So stop run there. So let's try and stop run. So I'm just going randomly. I'm just pulling anything I can see on my charts. But sub runs. Okay, there's a lot of them. Sub run. The same thing the market does every time. Okay, so I'm showing you guys a lot of examples about stop runs. So stop runs happens whenever there's massive liquidity resting around a level. The market would find it cheaper for it to just trade to that level and then quickly pull away. Okay, so let's see questions. A couple more examples. Jane, use the body of the week. Okay, so when people see gaps, they all tend to sell. The institutions do this on purpose. Not really. There's just lots of varying factors why the market is gonna expand quickly. Okay, there's lots of factors, but what is gonna happen is it's gonna cause an imbalance in the market because orders were not really fulfilled at a price point. That every price point there needs to be a measured amount of buying and selling to move price. Okay, so if the market is going up, obviously it's in a bull market. So who is selling? Okay, the market goes up, obviously it's in a bull market. So who is buying from whom to move the market up? Okay, and who is selling to whom? So there's always two players in the market: the buyers and then the sellers. And if you notice from COT data, okay, the institutions are always doing the opposite of what the funds are doing. So if you're most likely to do what the hedge funds are doing, okay, and then the institutions are gonna take the opposite of your orders. Now, if you look at every broker, there's always about 2, 3, 4 liquidity providers paired to each broker. And if you look at those liquidity providers, these guys are the market makers. These are the guys who move the market. We're talking about the big banks. Now, the guys who really move the market are the central banks. Okay, but now there's people who send blocks of orders to the central banks. Okay, this is all, it's very complex stuff. Okay, I think I'm going to teach you in another class. I'm going to do like a very deep breakdown of how orders are being paired in the market, how the market moves, all this kind of stuff. Okay, so there's different people who pair orders with the central banks to move price. Okay, and these are the big commercial bank players. I'm talking about HSBC, Chase, Wells Fargo, all those people. Okay, so there's different scenarios in the market that could cause the market to expand rapidly. But what you can best expect is whenever you see that kind of quick expansion without giving space for the market to fill in price, what the market would usually do at a later time is to come back to that level to fulfill that price. Okay. So let's see. Now I'm going to talk about the power of three. Okay, before choosing. Right, so let's see questions. Makes sense. To code so use the body or weights for the level. Bodies and weights. So all right, so let's talk about equal highs and then equal lows. Now, the reason why you're going to hear a lot of institutional traders talk about equal highs, equal lows is because around levels of equal highs, then levels of equal lows, these are very obvious levels. Okay, they're very obvious retail levels. And I like to call equal highs and equal lows retail traps because they are retail traps. It's very easy for retail traders to spot this kind of patterns in the market. Okay, and these are logical places where the market usually is going to retrace back into because there's going to be a lot of retail activity around that level in relation to what they are seeing. Okay, I showed you examples on gold. Equalize, equals getting smashed through. So let's pick any random pair. Any random pair. Okay, yeah. So we have GJ. Now, when the market came to this level, around 144, around 144, where there's this blue line, blue horizontal line there. What's going on with the Wi-Fi? Right, cool. So the market came to this level, then started to pull away. Now, this is a retail trap because people see these as, okay, this is a swing guy, a swing low. Let's pull out our Fibonacci from the swing low, okay? Pulling out the Fibonacci, you're selling. The market starts to go down. You're thinking, okay, so we're making money, blah, 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 blah. Then you're going to place stop orders or protective stops just above. So you're going to see something. Retail is thinking like this, okay? This is what retail is thinking. The market is going down. We've pulled out Fibonacci, blah, blah, blah. Once the market goes down, we're in profit. Let's pull stop orders just above old highs. Okay? So now, the market will then rally into that level. Now, all this is set up. All this is a ploy to get people to start to sell the market. But once people sell that market and you start to see price go down, like, sorry, and you understand that there is an equal high around this level with a daily bearish order block around this level, and then the market looks like it's going down, you can best expect a stop run. Okay, you're gonna see a stop run, a quick run to that level, then price is going to quickly pull away from that level. So what I'm saying, doesn't make sense to anybody at all. Stop runs, institutional manipulation, stop runs, all the jargon I'm talking about. Is it making sense to people? All right, perfect. So the market is then going to run up and then take out that level. The reason why the market is doing that is because there's lots of retail with stop losses around that level, that it is going to be profitable for the institutions to get to that level just to activate your stop losses. Okay, this is why we always want to sell into W's or double bottoms, and we always want to buy into M's or double tops. Okay, so you get the logic now. You sell into double bottoms, you're buying into double tops. Okay, now, sorry, let me give you an example. Equal lows. So let's see, play for this. All right, cool. So now notice what happens in the market. The market trades a range, goes up, then quickly pulls back down. When the market comes back down to this level, it creates an equal low. Okay, equal low, and then the market starts to rally. So what's going to happen is there's going to be a lot of dealing inside this range. There's people selling inside this range. There's also people buying inside this range. Then there's going to be stop losses up around above this range for the people who sold here. There's going to be stop losses below this range for the people who bought around these levels. Okay. So what the market will do is if the market wants to go down, it's going to quickly spike this level. So once the market spikes that level, it is effectively getting the sellers out of the marketplace. Now the institutions book profit because there's stop losses that just got triggered around that position. So now the stop losses gets triggered, okay, then the central banks book profit because there's lots of people, lots of retail, okay, who are protective stop losses just above that level. Now, if they spike that level or if they made a stop run to that level, you best expect you're gonna get back to equal lows. Okay. The reason why you're gonna get back to equal lows is because retail is gonna see this as support. Retail sees this as resistance. This is why retail is selling here. Okay. Now, the other side of the retail is gonna see this as support, and then you're gonna start buying these pair. So what you're gonna see is the market will quickly run back down to this level. In that way, the market took out the sellers, and then the market has taken out the buyers. This is why when you Google how many percent of people make profit in trading, it's a very few percentage. Okay, because the market is all engineered to get to your stop losses. Because there's a very high chance that you're gonna think the same way the rest of all the retail traders around the world are thinking. And if you're thinking like them, then it's very high likelihood that you're gonna get stopped out. You're not gonna be profitable because you're just gonna place your money where the central banks have engineered you to place your money around. Now, the market will then trade down into this level, take out the equal lows, as we're going to see in this replay. So the market is going to come down and then take out equal lows quickly because there's going to be massive orders resting around that level. Then the market does that there. Okay, so any questions? Let me know before we go into part 3 and how you can utilize this on a daily basis. Okay, so let's figure this out. Right, so another example, let's use DXY. Okay, so DXY, we add, let's use this. I think plus 2. Yep, I did. GG, that is a mitigation block. All right, so on DXY, there's a very clear example here. Around this level. So now, if you see what price did, there was equal highs, okay? So I'm just gonna draw a very crude line. Oh, come on, this is so it's not straight. It's just this. Yes, this crude line. Okay, so there's equal highs on the DXY. Now note we have equal highs and then we have equal lows. Equal highs, equal lows, and then equal lows. Massive equal lows. Okay. Now, if you have equal highs, put that, go to your daily time frame. Now, you have equal highs, the market creates equal lows, equal highs, equal lows. Right? I told you you want to buy into double tops and then sell into double bottoms, meaning W's you're looking to sell into W's. Now, the trend obviously is a downtrend. Okay, you have higher highs, higher lows, higher highs, higher lows. Then the market comes down, breaks market structure, market turning point, and then you have a lower low. You can best expect that this is going to be a lower high. Now, if you're expecting, you're expecting a lower high to form, okay, and then you have equal highs. The market is currently trading around equal highs, okay? Now, why do I call this equal highs? You have 1, 2, 3, 4. The market looks like it is resisting this level. So now, if you as a retail trader actually saw this, you're gonna want to sell this, okay? You would have wanted to sell the DXY. You're thinking, okay, the market is respecting this level. I'm looking at the market going down. So you would have wanted to sell this level. Okay. Now, there's chances that there's lots of other people like you doing exactly the same thing. You're selling around that level. Now, if you're selling around that level, you can best expect that there's going to be a stop run. The reason why there's going to be a stop run is because there's lots of sell action taking place around this level. Okay, so what the market would do is the market would spike up and then quickly pull away. Okay, spike up, quickly pull away. So now the market spiking up effectively takes out all the sell side players in this marketplace. Everyone selling with protective buy stops above this level gets stopped out. Okay, and then those who trade breakout systems, okay, with buy stops just above this level, the orders gets triggered and then the market never gets back to that level. The market triggers the orders and then never gets back to that level. Reason why is because it's not going to be profitable for the institutions to allow the market to hang around those levels. Now, if you see the market spike equal highs and then the trend is bearish, you can best expect that your first tip is going to be equal low 1, equal low 2. Okay, so now you're using the direction, okay, of the manipulation in line with your trend. So if the market is bearish and you see the market creating equal lows, you want to sell into that equal lows as your TP. Because there's a very high likelihood that lots of retail is going to see that as an area to keep stops around because they feel that is a support level. Okay, then the market is then going to get down to that level first. Let's see the market go down, 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 down. So the market is going to get down to that level first, then second level, equal lows 2. So let's see, power of 3, talk about that. Okay. Yeah, so now, if the trend is bearish, okay, if the trend is bearish, then and once you see price take out an old high, okay, you can best expect price to come for equal lows again. You know, I pause the shit, it's still playing. Pause it. Oh, come on. Come on. Okay, so DXY was bearish, took out equal lows 1, There's equal lows down that level, and then the market ran up, took out equal highs because we're so bearish on the DXY. Okay, let me actually cancel this because it's stupid. Wow, play. Okay, so all right, cool. Now, if you're bearish, once the market takes out an old high, then you know that there's a level of stop resting around that region. Because if the market is bearish, okay, there's going to be people selling that currency pair. There's going to be people who got in late in the move, then you're selling, the market goes down. Okay, now once the market gets back up to this level, then takes out this equal high, that is a reasonable place for retail-minded traders to place your stop losses at. Okay, people who like to trade their positions would place protective stop orders around this level. So once the market spikes to that level, that is a good level to sell back into equal lows. There's still going to be another side of the market who think it is time to buy USD, the DXY from this level, and they would like to place their stop losses below this level because they feel this is a support level. Okay, so areas of old highs, old lows are logical areas for price to, for you to see a stop run into. Okay, now remember, if you're trying to sell a double top, make sure your trend is bearish first. Okay, because what the market is going to do is, oftentimes you're going to see the market is trending bearish. Okay, the market is going to trend bearish, then there's going to be a correction of some sort. Then an equal high will be made. The market will quickly spike that and then go down. Okay, because institutional order flow is bearish. This equal highs or double top was just being engineered to get people, okay, to sell from this level, so that when institutions move the market up, you can actually book a profit from this move down. Okay, so you're booking profits by getting your stop losses. Perfect. So now let's talk about power of three. Now, the power of three, the way I learned my own power of three was, I taught you guys already. If you're looking at a bull candle, you're gonna see the open. Oh, come on. You're gonna see the open for a bull candle, low, high, then close. Okay. Open, low, high, close. So now you're gonna ask yourself this question: why is it that in bull markets you're getting open, high, low, and then it close? Okay, how far do I let price go above equal highs? Once I start to see price, so what I usually do is when I spot equal highs, okay, and the trend is bearish. So once price, I'm gonna expect price to spike those highs. Once price does that, then I'm going down to the smaller time frames, the 15-minute or the 5-minute, to see if price is showing signs of pausing. Okay, if price is showing signs of pausing or reversal, then I'm taking that trade. I'm going to use 30 pips stop loss above or below, depending on if I'm buying or selling. Okay, so power of three. Okay, now on a bullish day, you're going to see the market do this. It's going to open, trade down first, trade up, then close. Now, from the guy I learned this from, ICT, he said in the 1980s, when he was still trading futures contracts, okay, because he was trading every day and there was not really this computerized system where we could just open our laptops and pull up any charts from any currency pair or asset class, whatever. So the way they traded was Come on, where's Telegram? Okay, so let's close Telegram. Okay, cool. Right. So he said they were trading with paper-based trading. So what they did is once the market opened and then the market traded down first, okay? The guys who wanted to buy, there's this guy, Larry Williams, who was like ICT's first mentor. So they wanted to know how to get direction of the day. Okay, so if the day is bullish, how is it that there's people buying around this level, okay, and holding for the entire profit taking of the move? So what I'm trying to say is when the market opened, okay, the market opens futures contract, soft GMT, then when the market dropped down, and then the market rallied up, your system of trading is once the market goes up past the open, then you're gonna buy, okay, then place surplus below the candle close or the lowest point of that day. Okay, then you're gonna hold the market until the market goes up. Now, that might seem like a good strategy, but there's sometimes where you could get turtle soups to Asian range. So the market would go up and you get a whipsaw, then the market goes down. So there was this question of how do people know, or who are those people buying at the low before in the bullish day? Who are those people accumulating buy positions at the low of that day and holding onto the close of that candle? So how are people able to know that today you're going to buy around this low and then you're going to hold, okay, and then take profits at the high of the day? So it was like a mystery to them until ICC himself unlocked this. Okay, so this is where you get your power free. It's standard way the institutions manipulate price every single day. Every day, this is the way price plays out. Okay, and I'm sure I showed you guys before, but I'm just going to re-emphasize this so that it drives down. Okay, it drives down home. So you get your open. Then price goes down. Okay. Now there's open, then price goes down. So a lot of people, this is okay. This is a bearish day. We need to sell. When people wake up from your charts, they open the laptops and they see price opens, price is trading down. To them, this is a bearish day. They want to sell. Okay, that is what majority of people are going to think. Now, what is happening is this is the manipulation from the open. The institutions are accumulating their buy positions at this low. As price drops down, they're buying. Okay, because they know they want to engineer the price to be bullish for that day. Now, for price to be bullish that day, they need some people, okay, to take the sell side of the buy positions they want to assume. Okay, so they want to assume buy positions, but for them to move the market up, they need to drop the market down first to convince people to sell. Hopefully that makes sense. So this first phase of the market dropping down is the accumulation phase. So let me write that out. The price or the institutions are accumulating price. So call this the accumulation phase. Okay. So price accumulates around this level. Okay. Then the market then goes up. Now the market only goes up after the institutions have assumed the buy positions. Okay. And then the retail herd has assumed the sell side positions. Okay. Then the market goes up. This is called the profit release phase, meaning you're taking profits from the buy positions they assumed below. So we call this profit release phase. Okay? So this is a profit release phase. The market goes up. Okay? And then the market then comes down, and then smart money distributes the positions, which is here. This is where you get your candle close. So when the market starts to pull back down, market price has been distributed, and then the institutions are then going to reset for the next day. Okay, so if it is a buy day, you're going to see this. The market is going to open first, go down. That first bearish move is where they are assuming the buy position. For them to take price up, they need to move price down. So this is called your power free, the accumulation phase from price open. When price makes the false move, then the true move is the profit release phase, and then the close is what we call the distribution phase. Okay, now you can then make that out to be in a range. Okay, because what you see play out every day happens even on higher time frames. Because typical, I told you guys last week, last week, the way the days being engineered is from Asia, you're going to get a range. Then towards London, you're going to get a false move. And around London, you're going to get your true move. To the close of the day around New York, then you have your close. This constitutes a bullish day in price. Okay, now the same thing applies to higher time frames. When you start to see price form a range, okay, price is ranging, ranging. What is going to happen is that range is going to attract a lot of people. A lot of people are going to look at that range and then would want to assume positions in that range. Okay, so a lot of people are going to look at this range. Retail traders, hedge fund traders also, all looking at this range, trying to assume positions. Now, what's going to happen is the first move out of that range is the false move. False move out of the range. The reason why this is a false move is because everyone thinks this is a breakout. You're looking at this as, okay, I have my breakout, I'm selling this currency pair. So everyone's trying to sell this currency pair because they feel, okay, this is a breakout from the range. Okay, so now if the institutions want to move price up, they need to push price down first. So if they push price down, people are selling price. As people sell, they are taking the opposite orders and then they're buying, and then they assume your buy positions down here, then price then trades up the true direction. This is where they distribute price. Does this make sense to anybody? Let's see. Yeah, so the same for bullish weeks. Yeah, okay, bullish weeks, bullish months, that applies for every candlestick. All right, so in tight ranges, the first move. Now, out of everything I've said on this webinar, I want you guys to write this down. Write that down, because you're going to see every day, it happens every day. In tight ranges, the first move out of that range is the false move. Okay? Lower time frames, yes. I'm going to show you lots of examples, okay? Random examples. In tight ranges, the first move out of that range is the false move. The false move is the first move out of that range. Okay? So now let's look at a lot of examples. Let's see. We're gonna use, okay, gold. I think there's a very clear example. Delete. Okay. Yeah, so remove all drawing tools. Play. Okay, so all right, so there was a very tight range on gold, very tight range. Price is ranging. Now, was the first move out of the box bullish or bearish? What was the first move out of the box from the range? Bullish or bearish? So Bearish. Perfect. So the first move out of that box was bearish. This is the false move. They want you to sell this. Okay, it's the false move. Now, what you're going to see price is then going to rally up because they've gotten a lot of people to sell this move. The price is going to go up. So this kind of setup is one of my most favorite setups to trade. Okay, the power of 3. So accumulation. let me write this out for you guys. So price ranges, institutions accumulating price, then the first move down, the false move, manipulation, then the true move is the distribution. Okay, hopefully that makes sense. Let us look at USD CAD, famous for its power 3 moves. USD CAD, let's go. So, all time frames. Remove alternate tools. Okay, so now let's do play so so this is USD CAD. We have a bullish order block from this level, so could expect price to be bullish from this level. We want to see bullishness in price from that level. Okay, and you go to our smaller time frames, pull out the period session breaks. Okay, perfect. Now notice our price basically creates a range inside in this level. Okay, this is another time frame auto block. We're expecting price to get to that level, then trade up. But then we can see a range on USD CAD. So USD CAD is currently ranging. The first move out of this ranging box is the false move. Okay, so now what price then did was trade down. Now, what do you want to see price do? Go up or go down? You want to see price go bullish or price to remain bearish? From what I just taught you guys, remembering that we have a daily time frame order block around this level. So bullish, okay. Everyone says bullish and then go up. Right, so we have another range around this level. Okay, there's another range around that level. Now, are you buying or you're selling from that range? Is this a sell or a buy? Let's see. Buy, correct. Because then the market then goes up. Okay, very neat buy. Why? Power of 3. Ranging, which is the accumulation. Then the false move out of the box is the manipulation. Then the true move is the distribution phase. So you as an institutional trader, your goal is to place yourself in these moves before the distribution phase. When price makes the false move, that is when you want to be doing your buying. Now, the reason why I said this plays out every day is because I taught you guys, okay? Remember a previous session, Asian session usually gives you your range. Asian session gives you your range. Then towards London, you get the breakout. This is your power of 3 on a daily basis. I'm literally giving you everything you need to know about trading every single day, knowing direction every day, okay? Asia is going to give you that range. Then out of Asia, the first move out of that range is going to be the false move. This is what everyone is chasing. Everyone is trying to sell. Whilst everyone is trying to sell, you should look to buy. Okay, whether you're expecting price to bounce off your Fibonacci level or your other block or mitigation block, whatever. So once price breaks out of that ring bearish, you're looking to buy that pair. Now let me give you examples, lots of daily examples. Let's look at GU. Okay, we have all the days here. So let's go back to the last 2 weeks. So we're gonna use last 2 weeks price action. 16, 17, 18, 19, 20, 23. Okay. So let's use from 16. Yes. 2, 1, 2, 3, 4. 1, 2, 3, 4, 5. So okay, cool. Now notice how from Asia there was a range, very tight range. Okay. Asia, you have a very tight range going into 8 a.m. London. Okay. So what was the first move out of this tight range? What was the first move? Bullish or bearish? Let's see. Bullish, exactly. So if that first move is bullish, you want to sell. If the first move is bullish, you want to sell. Okay? Cool. So yeah, there wasn't really a range, so we're gonna ignore this. Okay? There we're ignoring that. Yeah, there was a range in London, not Asia. Okay, now here's a very perfect example. There was another range here. Okay, so now let's take this to the left. Now, are you gonna sell or buy? Let me zoom in so you guys are gonna see this full screen. Range, what are you doing? Selling or buying? Now let's look at the time if it falls in London. Yeah, this falls London, 8:15 a.m. Are you selling or you're buying? I just taught you guys now. Are you selling or you're buying? Selling, exactly. So you're selling, price goes down. And you were correct. Okay? So to get the same thing, we're gonna apply the same things we learned. Okay? Are you selling or you're buying? This is a range going into London. Sells or buy? Let's see responses. So, okay. Okay. So, right, cool. So price eventually went down. If you sold from there, would have been 55 pips. You would have to see through 48 pips worth of drawdown. So I don't know. Let's see. This actually was okay. Yeah, cool. So this move actually came late into New York. New York session. That was when we got the move. But it was still a bearish day. Okay. Bearish day, and London tight range, very tight range. Then out of that range, you get a breakout. Everyone thinks it's gonna go bullish, and then the market eventually sells. So you have your manipulation, your accumulation, manipulation, and then your distribution. Market eventually distributes to the downside. So the power of three simply is a tried and proven way in which the institutions engineer the marketplace, okay, to trap retail traders. So this is all institutional manipulation and then stop runs. So whenever you have areas of equal highs or equal lows or old highs and old lows, okay, you can expect price to trade into that region for a stop run. We call that a turtle soup. Okay, and tomorrow's class, I'm going to show you guys how to trade turtle soup. So today was actually just to give you guys an intro into how turtle soups occur in the marketplace and how you can utilize your power of 3 into trading every single day. Now, tomorrow is where we're going to do chart work all through. Okay, so we're going to go through lots of examples why we're looking at the market going back to equalize, equal lows, taking out equalize, equal lows, how to know when the market is going to do that, how to utilize that into trading every single day. Because if you know your power of 3, that is one of the major keys to trading daily ranges. Okay, you can trade daily ranges, but how are you going to know the direction of the day? Your power of 3 is going to tell you that. Okay, and how are you going to be able to trade that? Your power of 3 is going to tell you that. So this is going to be one of the first steps into unlocking day trading. Then from there, we're going to go into deeper classes on. I'm going to teach you guys about mitigation blocks, breakers, all those stuff. Okay, but first you guys need to master what your power of 3 is. So now, an exercise before tomorrow's class, just to test yourself for before tomorrow. I want you guys to go into any pound or euro pair, okay, and then wherever you see an Asian range that is tight, look for the first move out of that box going into London. Okay, designate that your manipulation and then look for the move opposite to that initial move. This is going to build you up on learning how to view power of 3s in the marketplace. Okay, so this session was recorded. We ended with 29 people on the call. Not on Discord too. No, how do we join if we were with SMT? I don't know. Any ways you can. So the thing about me nowadays is I barely reply Instagram messages and Telegram messages because I'm so busy. So if it's not being dropped on Discord, then maybe I might tell Bailey to accept on the SMT group chat. So Bailey's gonna go through everything. So if you're sending your assignment, tag at Texas Trader. It's gonna go through everything and then tell you if you're correct or not. Not the Discord. I'm talking about the SMT group chat. Yeah. All right. So I think this session is already way extended. And good night, everyone. I'm going to send the recordings to those who asked for it. So hope you guys all have a wonderful night and watch out for this week's trading.